Forex Focus brought to you by IG. Have to talk about the huge move higher in bond yields here in the U.S. And then also I want to rope in what this has meant for the U.S. currency, as dollars have been trading near their highs against a number of major partners abroad. But first, let's get into some of this price action we've seen in the 10-year specifically. This is the benchmark that we usually look at for U.S. yields. And the U.S. 10-year has climbed more than 10 basis points today and is now just a handful of basis points away from 5%. So right back to those multi-year highs that we saw a few weeks ago before the Middle East, the war has broken out there, moved interest rates a little bit lower, some fear setting in, right back at it, and has a lot of people wondering if they will break through this 5% level that they have not since 2007, and in the 06-07 range, 10-year yields trading between 5 and 6%. And so really not too far off from almost 20-year highs in 10-year yields. We're right there near those highs since 2007. And then, of course, before that, you'd have to go to the early 2000s, 2000, 2001, to see interest rates above 6%. But this is to say, huge moves higher in bond yields here in the U.S. across the curve. You'll remember that this was really a short-term yield story for the majority of the last 2 years. Inflation moves higher, the Fed raises their overnight rate, Treasury bills from 1 month out to 6 months out to a year out. Those interest rates move higher, but the market thinking this is a short-term thing. Inflation will come in, the Fed will move interest rates back to 2 or 3%. And so 5-year, 10-year, and 30-year, you're good at 2, 3, 4%, setting in that these interest rates might be higher for longer. And that's why we're seeing this recent run up close to 5%. But, you've seen some of this play out in stocks, tech stocks, particularly not liking the high interest rate environment, certain sectors not liking it, but stocks becoming, maybe they were shocked in 2021, 2022 by interest rates moving higher. Even though we're at the highs for interest rates for the last several years, we're not at the lows, even close to lows for the stock market for the last several years. So getting a little bit comfortable, but a market that we are seeing extreme prices in, coinciding with this extreme yield curve we're seeing in the U.S. is that dollar market. And you can see here when I stack up the 10-year in that black line against dollar yen, the chart that's in the background there, you can see the correlation, right? I mean, this is over the course of the last couple of years, and highs in bond yields being around highs in this dollar. As you see the two, one in general rising together, but tending to peak and kind of move lower together as well. As the dollar yen is near 30-year highs that they saw in October of last year, around the same time that U.S. yields are trading near 15-year highs. And you throw the correlation on top of it, and you see very highly positive correlation. I'm usually trading between positive 0.25 and just north of half. And right now sitting right around that half. So pretty strong correlation at the moment, given historical correlations, letting you know that on, more days than not, these two markets, U.S. yields and U.S. dollars, are moving in the same direction. And now the question becomes, okay, if one moves higher, the other's likely to move higher. If one moves lower, the other's likely to move lower. And now you have 25 years of data here from the dollar yen market, and they're in blue, the 10-year yield market. And you can see this trend playing out. And of course, there are periods where dollars rising and yields are moving lower. There's breaks in these correlations. all the time, but especially recently, from the pandemic lows and interest rates around 0%, close to 0% for the 10-year yield, that climb from around 0% to where we are now, near 5%, coinciding with a pretty historic run in dollar to the upside as well. So the correlation's there, sure. You see the historical data, yeah, fine. But how likely are they to both move higher? Of course, there's theoretical 50-50 of both or either moving in either direction. But they're definitely near their upper limits in terms of historical ranges. And you have to wonder at what point, the Fed saying higher interest rates for longer, that was 3%. We thought it was going to stop there. 4% became the new normal. We thought it was going to stop there. Now we're at 5%. At what point is that higher for longer good enough? Is it 5% or is it 6% here? As rates have been higher in the last 20 years or so, dollar hasn't really seen higher prices than we're seeing right now. So maybe based on historical prices, a little bit less of a likelihood that this dollar market can continue higher. But I mean, you would imagine that strength in U.S. rates could see some strength in dollar. But again, man, both are pretty near to their highs. That being said, like I just laid out, rates have been on this unprecedented run, and every step of the way, every major percentage increment has felt like the high, and they've built in further ground to the upside. So only time will tell if they both continue higher or they normalize lower a little bit, given recent historical prices here. And of course, you do have to keep in mind that 150 price between dollar and yen, not because any big number is very important and it can't trade higher than that. It did trade higher than that last year, and it broke above it intraday for a little bit in the last couple of weeks here. But that has been a level that the Bank of Japan has come in and tried to intervene historically to the downside. And you saw that's where yen turned around last year. It was right around 150. So you throw that into the mix, and the fact that, U.S. rates can stay higher, and the reason for dollars to break their correlation with U.S. Rates, maybe the Bank of Japan starts to get some data in on their end that causes them to keep in mind they're in negative interest rate territory still. They haven't hiked once over the course of the last couple of years. So anything they do could not necessarily move U.S. rates lower, but could move that dollar lower. So many angles on the table here. Plenty of room for you to develop your own. In terms of traders at IG, 83% of forex traders in this market are short that dollar, long Japanese yen, as they obviously think that this is a price extreme that will not move higher. Now, of course, this isn't any indication of the future, but that's a large number there at 83% short the US dollar.